nice to welcome all of you to today's Tech Talk. Would love to just get it started with a couple quick introductions. First off, I'd like to introduce Itai, who is the founder and CEO of Unit, and also Ben Brown, who is the cross-industry financial services lead at Accenture. I'll let the two of them speak a little bit on their own behalf and what their respective organizations do and how they've kind of partnered across the ecosystem. Itai, maybe if you want to go first.
Sure. Hey, everyone. I'm Itai Damti. I'm co-founder and CEO at Unit. I'm based out of New York. Unit is an enabler of embedded fintech, just like Plaid. So we help tech companies launch accounts, cards, payments, and lending products. Just like Plaid, we believe that we can make a real dent in the world by making it easier for builders to build. And maybe I can spend a minute explaining why and how we started the company. So Doron and I, the founders at Unit, both previously spent 10 years at a trading infrastructure company that we started and scaled globally. And in 2019, we decided to approach the problem of building embedded fintech from first principles. So we looked at how fintech companies like Chime or Venmo have been built since the big fintech boom of 2008. And we noticed that they all have three major sources of pain when they get to build fintech, even V1 of their product. They need to strike a bank relationship and manage that relationship typically for 5+ years. They have to build a lot of tech to get to a competitive product that just gives you the baseline for competing in the market. And they need to own every single compliance and regulatory activity that gives them the permission to operate a bank account. We thought that it could not be a scalable and safe approach, especially for builders that don't have a full fintech DNA as we think about it. And that's what we think embedded finance is all about. So what we decided to do was to take the three areas of pain, bank relationships, tech, and compliance, and build them into Unit in a way that just exposes APIs, dashboards, and white labeled UI components. That's what we took to market in late 2020. We raised 70 million to date from top VCs and angels, including Excel most recently, and we're building embedded finance with top brands, including AngelList, Invoice2go, and more. So that's a bit about us, and I'm passing it in to Ben Brown, the cross-industry financial services lead at Accenture.
Thanks, Itai. Thanks, Eric, also for hosting this webinar. Really excited to be here today to talk about this super interesting topic. So as Itai said, I'm part of the financial services leadership team at Accenture, and I focus on supporting new market segments, including growth stage fintech companies and cross-industry financial services initiatives. I help to bring our really deep expertise and capabilities to companies that just might be starting to climb the learning curve of thinking about how to do things in a very different way from how the industry has traditionally done them. This is actually a topic that's near and dear to my heart. It's a topic I spend a lot of time on at Accenture. And it's something that for Accenture, we see happening all over the place. We'll talk about that a little bit later in terms of some of the research findings that we've done recently, but we definitely see industry convergence happening across the landscape, not just to financial services, but in financial services as well. And it's been a topic, this embedded finance concept has been a topic in some of our thought leadership over the past couple of years, including our 2021 commercial banking top trends. One of the trends we included was the statement that many of you will be familiar with. Many people champion this concept. Itai and I will argue about it later, but every business is a fintech business is one of the things that we see out there in the commercial banking landscape based on that appearance of financial services within the offerings of many software and platforms companies. And beyond just research and thought leadership, we're hearing all the time from clients, both in the financial services industry and outside of it, a lot of interest and excitement and questions about what is embedded finance, how do we engage with it in the right way, is it relevant to our business? And as we'll talk about later, there really are a lot of interesting, strong benefits to deliver new revenue streams, create greater customer stickiness, access new markets, et cetera. So, really thrilled to be here together today and chat more about it. I'll hand it back over to Eric to take us home.
Thank you to both of you. It's great to be here again, like I said, to host this session. I don't want to spend too much time on Plaid. I want Ben and Itai to be able to share a lot of the insights that they have. But just in case any of you are not familiar with what Plaid does, we're a data network that powers many of the digital financial apps that you know and love. We have almost 6,000 applications on the platforms that are connected to more than 10,000 institutions around the US and increasingly kind of globally as we've expanded into Canada and Europe. And so our focus has always been on making it incredibly easy and safe and transparent for consumers to be able to connect their financial data to those applications. We've grown with a number of customers over many phases. If we want to, we can skip ahead to the next slide. The first wave was a lot of the big fintech players, the Robinhoods, the Venmos, the Cash Apps, the Chimes of the world. The second wave was really focused on kind of bank innovators, American Express, Bank of America, Capital One, Chase, and many others. And now the third wave that we're seeing from a fintech perspective is a lot of the next generation kind of technology companies that already have large consumer bases and customer bases that are increasingly finding ways to kind of embed financial solutions into their flow as well. And in all those cases, it's folks like Plaid and some of the other players across the ecosystem that are able to kind of help these players make that possible. It tends to create a tremendous amount of consumer value to be able to kind of get these services at the point of need, as opposed to having to separately bring them to the kind of the transaction endpoint. But it's an amazing time, I think, for any of us in fintech to be alive and building companies at this particular point in time, where you have literally everybody kind of gravitating towards this opportunity to kind of embed digital financial solutions in so many different ways. And so with that, I think Itai is probably best positioned to talk a little bit more about like why now is actually such a good time to be able to be active in this space.
Yeah, so the transition from what we call FinTech 1.0, the wave that started roughly in 2008, to the new wave of FinTech is all about a different DNA of builders. And it really warrants the question, why is there a new generation of companies with a different DNA that wants to get into finance? So again, old FinTech companies are pure play FinTech, 100% FinTech in their DNA, and all about focusing on one product initially and eventually expanding into more product. What we see now is that more and more companies in tech that have a vertical focus, we'll mention some of them in a bit, have been spinning a flywheel of software, trust, distribution, and data for a long time. Think about companies in the account payable space, or think about companies that provide personal financial management advice to individuals, to businesses. They may have more of these assets today than in the past, and they step up their ambitions and they feel like they can monetize a lot better with this new wave of financial services that are extremely high margin. So that's the flywheel and the ambition side. So that's one. Second is, of course, every company that takes any business move considers the cost benefit analysis. And in the past, when even if the benefits seemed promising, the cost was prohibitive to experimenting in financial features and in embedded fintech. But now that there's infrastructure, this side of the equation is mostly solved for, or at least the effort in launching fintech is dramatically lower, and it makes more companies get into financial services, even if they're 80% sure or 70% sure that they're there, that they can turn this into a large business. And then a last point, which I think is nuanced, but very, very important, is that I think competitive dynamics in every vertical software category are kind of forcing everyone to be comprehensive as much as they can over time. So if you look at how our smartphones developed, a camera used to be a big delighter. It used to be the reason that you buy one smartphone and not the other. And then over time, all of these smartphones now have those features. So can we look at financial features like bank accounts, cards, payments, and financing, and treat them almost like product features in the sense that there's a roadmap of them, but I also have to be responsive to how my competition acts. And so I think in every category in software, we can see how one company gets into financial services, and then we can see how almost all of their peers are rushing to match it. And I think it's going to be a long journey until all of these companies are sufficiently comprehensive in their suite. So that's why we think is the why now for that space. And of course, infrastructure is our job, but the market is doing its job in the other fronts.
I'm happy to jump in on the next page here and take a few minutes to share some of the insights from a report that we recently co-produced together with Plaid. It was a lot of fun working with the Plaid team on this and interviewing different stakeholders in the embedded finance ecosystem, including banks, brands, and the platforms that bring them together, like Unit. And actually, it's very, very fun because we've done a lot of thinking for banks historically on new models for banking experiences, what banks do for their customers, how banks reach their customers. But this report was a great opportunity to kind of look at the issue from a different perspective, from the perspective of those non-financial companies, how brands are thinking about the topic, and what that means in terms of best practices for financial institutions that are looking to play in this space. So one thing that we did as part of this effort is not just write a paper together based on our presumptions and hypotheses, but actually go out to the market and talk to corporate leaders at non-financial companies who are at that leadership level, at that director level and up, and ask them, are they engaged in embedded finance pursuits? Is this something that they're investing and offering around the world? We actually surveyed 1,000+ people around the world, 200 executives here in the US. That's what some of these numbers are based on. Really, interesting numbers, right? So almost half of the companies that we interviewed or surveyed are investing meaningful amounts of money, 10 million plus to enable financial services within their offerings. 68% or so reported financial services and embedded finance as being, one of their top priorities. And as you can see here, companies that are leaning into this are seeing benefit from it. Almost 90% of the respondents in our survey said that those embedded finance offerings they rolled out actually are increasing customer engagement, and they're seeing benefits from it. So, I think a really interesting set of responses there that indicate how broad the market opportunity for embedded finance is. It's something that, companies believe there's promise in, and those that are leading the market and actually making early investments, getting some experiences out there, are actually seeing real results from it, which is creating this, positive feedback loop for companies to experiment in this area that, as Itai said, there are some catalysts that are changing it today. In the past, maybe it was interesting, but way too complicated, way too risky, just kind of off limits. And today, some of those conditions are changing that makes it much more feasible to offer embedded finance services. So I think as we look at the next page, just taking a look at, what is embedded finance? We think of it as the offering of financial services in context, in the context of those life moments or business challenges or other things that they're really meant to enable. So many financial services are really a means to an end. And so traditionally, you'd see financial institutions going directly through their own channels to reach customers. And what embedded finance is doing is not necessarily displacing that, but it's adding to it to say that your proprietary channels are not the only ways to reach customers. Now you can go through merchants, you can go through manufacturers and consumer brands, you can go through software platforms, e-commerce platforms, et cetera, and kind of connect that financial service that you're offering closer to the product or the experience or the challenge that it's meant to help resolve. And there's benefits in both directions on that too, because it's not just about accessing new distribution channels, but also there's data that those partners have to potentially contribute into the risk and decisioning and servicing processes that financial institutions take on. And we really see embedded finance enabling these life moments across all the segments of financial services. So whether that's banking, credit, payments, investing, insurance, sort of all of these different segments, we see examples out there in the market, all public examples you see here on the page, but it gives you an insight into, what does embedded finance really mean? For example, Intuit has launched QuickBooks Cash, business bank accounts for small businesses using the QuickBooks platform for their bookkeeping and business management. And it embeds it right there into an ecosystem and a platform that is already managing many of the parts of your business. So you don't have to go to a totally different site or solution to get access to that money and move things around. Amazon lending in the second column there, another great example where sellers on Amazon Marketplace, can actually receive pre-qualified offers of credit for growth capital that is then repaid out of their Amazon sales over the subsequent 6 to 12 months. So it's something that is not just a loan product that's kind of on a shelf for people to come ask for, but instead something where there's a platform there that you're already selling goods through. They can see your business activity. They can use data analytics to identify when you might need that capital and make that offer for you, tailored in a way that they know you have the ability to repay. Payments with Shopify, including Shopify Payments and Shop Pay, their express checkout solution. I think a really interesting example there of coupling payment processing into the commerce platform. So it's all part of an integrated suite. And then even in the investment and insurance space, Griffin is a startup here that we've spotlighted in the paper. They have a stock where you shop proposition, where you connect the Griffin platform to your payment card, and they can see that every time you go buy something at a publicly traded company like Starbucks, for example, they'll invest $1 or some amount in the stock of that company through fractional investing, which is a really interesting experience. And then for insurance, I think Tesla provides an interesting example there. Tesla's gotten into the connected insurance space in California and Texas. They're actually using telematics data in Texas from the cars to set premiums for Tesla owners so that it makes auto insurance for Tesla drivers more accessible, more affordable, much easier to sign up for right within the customer experience. And across all these examples, we're really seeing a lot of benefits to companies that are leaning into this space. So as we said earlier, this could result in stickier customer relationships, lower attrition from people who are just cross-shopping on price. They're actually seeing a lot of integrated benefit to having those financial solutions that are connected to the things that they're meant to enable. We're seeing better margins as well for companies that are leaning into this space, because financial services actually have relatively high margins compared to industries like retail or grocery or food, that have single-digit margins. Financial services can be quite a bit above that. And so for those companies thinking about offering this space, the ability to participate in some of those revenue streams, it creates value for the customers and for the company. And then finally, increased engagement levels. When you can bring together financial services and the things that they're meant to enable, you can present offers to customers at the right time on the platforms that they're already spending time on, the platforms and tools they're already using to manage their personal finances, run their businesses, do whatever they're doing, then you actually see a lot of synergies there. And then finally here, one of the other insights that we got from the survey is that while a lot of companies are ranking financial services and embedded finance as a top strategic priority, they're actually, a lot of them saying, hey, we need to work with partners to make this happen. These non-financial brands out there, they're not saying, we want to go displace the financial services industry. They're actually saying, hey, it's really interesting to connect these financial solutions with our products, but we need help with that because financial services, it can be complicated, it can be risky, there's lots of regulation, so on and so forth. So we actually need partners to help us navigate this space and make these things come to life, which is exactly why companies like Unit exist and Plaid exist out there in the ecosystem. And with that, I'd be happy to hand it back over to Itai to talk a little bit about how he's seeing companies lean into this and using embedded finance to differentiate their businesses and build competitive advantage.
Thanks, Ben. One addition to your comments is that we actually agree with you in not seeing embedded finance as a zero-sum game between incumbents and the companies that offer financial services. We think that there is a chance to create a bigger pie for the financial services industry. If you think in an uninspired way, embedded finance can be as big as finance itself because it's just another link in the distribution chain. But if you think differently about what kind of financing experiences or spend management experiences or otherwise companies can enable, it makes you think about this industry maybe in an pre-Uber moment in transportation, where there's going to be a player here or a bunch of players, 50, 60, 100 companies that are going to increase the GDP of the financial services industry. So that's just one thought. The next section that I will lead is really about how companies navigate that space. We'll start again by saying that embedded finance is a huge space. Insurance and wealth management and banking are hardly able to put in the same bucket. You're not really able to say that they're the same thing. So maybe what we can do here is touch on some of the actual examples for companies that do it in a banking context and in a business context. We'll start with the assumption that those companies have been spinning the flywheel of software, trust, distribution, and data. Look at all the names here. Take 5 or 10 seconds to think about all the data that they have on all the different stakeholders on their ecosystems, and you'll start to understand why it gets interesting to get into financial services. It's a better way for them to capture value and give value and accumulate data and revenues along the road. So that's the set of players that we're seeing getting into financial services. And it's not only established companies, we also see a lot of younger companies developing a vertical focus from day one. For every Shopify, there are 12 companies that are younger that want to serve merchants that are selling on Shopify, Instagram, and 10 other places, and are trying to give them financial services. So the vertical focus matters, but it comes in all shapes and sizes. Large companies that are more established and younger players that want to fight the distribution fight to get into that space and develop some vertical expertise. So that's the set of companies that are building. Let's get for a second for why they're building it in the next slide. So this is a piece of our seed deck that we developed 2 years ago, where we took the Etsy merchant dashboard and we just allowed ourselves to reimagine it in a way that includes a pretty comprehensive suite of financial services. In an Etsy merchant's world, if I'm selling something on Etsy and that's my main business, there's no reason why Etsy would not give me this large suite of financial features. So from the ability to store a balance that is everything I accrued in terms of the payments that I've processed, and the ability to earn interest, which was maybe more relevant 2 years ago than today, to sending payments, receiving payments, getting access to cash that I need, maybe towards the end of the month, based on my loyalty as a merchant. And then if you think about cards and how I finance my inventory, all these financial services can be delivered within one user experience. And that's how many companies think about the end game, but not all companies start that fast, right? You start with smaller feature sets, and then you expand over time, just like how you manage products more broadly. So in the next slide, we try to get into how do these companies hope to monetize financial services. And the 5 obvious revenue streams that we can point out are interchange. There is a serious regulatory advantage to companies that work with smaller banks. And that's what enabled companies like Chime and Venmo to come to life and issue cards. Today, interchange for card payments ranges from 1.3% for individual spend to 2.2% for business spend. So every dollar that Etsy is able to help me keep on that platform, every dollar that I spend on Facebook marketing or other types of promotions or vendor payments can then be monetized. So that's the most significant monetization opportunity we see today. The second one is, of course, interest. Companies can participate in subsidizing interest, but if they just want to offer the native interest that banks tend to offer, of course, in today's market, it's hard to monetize. There could be a point in the future where it could be as high as 20% of how we make money as Etsy. The third area is payments. If I'm a merchant on Etsy and I can pay my bills with a single click, there's a very good chance that Etsy can ask me to pay $2 for every such payment if it's a small number of payments for specific vendors. And those platforms can monetize payments in these ways just based on the convenience that they allow you to get. Financing is another bucket, and that's, to me, the 5x or 10x opportunity that will emerge in fintech over the next 10 years. How do all these companies, including Etsy, give me faster access to my money, right? How do I get a cash advance at the end of the month or towards the end of the month and potentially pay some fee or otherwise get a loan to finance my inventory. There are many ways to offer financial products in context, and it really matters what is the environment, because this context is everything in financial products as well. And then the last bucket is software. So think about all the first four buckets: interchange, interest, payments, and financing. You can choose to make money on them and offer your software for free, or you can choose to play an opposite game, almost losing money on all of them or making no margin on all of them and monetizing via software, or you can mix the two. You can play a medium margin game on both sides. So software is a really interesting bucket because the experience is dramatically enhanced. We could see companies that offer landlord tools charging $9.99 per month for access to a full suite of financial features, right? And not charging on the payments as much. So there are really interesting ways to play with these buckets, but mixing them is a very much an industry by industry case. And then companies can also build really interesting loyalty schemes, right? So if you pay for the software, you may get everything else for free. But if you choose not to pay for the software, we give you another set of terms in all these areas. So that's really how companies think about monetization. And of course, the flywheel that they've been spinning is the why, from the why not side, but monetizing this is top of mind for all of them. And that's how they think about it. The next slide is really about what we think the cost used to be and what the cost is in building financial products today and in the past. So before 2020, it took companies a very long time and a serious investment to add simple financial products like deposit accounts or cards into their product. And the main costs were the bank relationship, the compliance, both the 15 to 20 compliance policies that it takes to launch a successful financial services offering, and the tech that has to be built. So companies like Chime built experiences that we now take for granted, but they had to invest many millions of dollars in making them happen engineering-wise. And so today, what's happening is that companies can invest as little as 6 weeks and a double-digit thousand amount in adding deposit accounts and cards to their products. And the way we see it at Unit is that there's always some sort of initial brainstorming and ideation that takes place in the company where they debate on the order of adding those financial products, on the terms in which they want to add them. And then once they have a solid idea for how they want to approach it, we kick off an implementation with them that has 4 different work streams: tech, compliance, legal, and ops. And at the end of this process, after we checked all the tasks in the list, they get the production keys and they're able to create their first bank accounts, cards, and payments. And so you can see how this shift in high cost, high investment to low cost, low investment really makes companies think differently about adding financial services. And it really makes them experiment more than you would think, because now the cost benefit is really leaning towards the benefit in their consideration set.
That was great. Thanks, both of you. Lots of really, really good insights there. I think at this stage, we were going to go into a Q&A, but I also saw a lot of folks submitted some really, really good questions. There were some pre-submitted questions as well. And so maybe we tackle some of the questions that folks on the call have submitted. If you do want to submit additional questions, you can do so by clicking on the Q&A icon at the bottom right of your screen and add questions to the ones that are already been asked. To start it off, the first question was around people asking if there's a recording of the call that we would make available. The answer is yes. We'll make a recording of the call available. We'll also provide a copy of the Accenture report. So everybody on this call should be getting that. The second question was around the survey itself. So I think this question is for you, Ben. The first part was it primarily B2C companies or did it also include B2B?
Yeah, we didn't filter on that dimension. What we tried to filter on is non-financial companies. So companies that aren't banks, aren't insurance companies, aren't in the capital market space, that are outside of that and are looking at whether financial services make sense to them. And they could be serving consumers and they could also be serving businesses.
And then the other question was, out of those 1,000 corporate leaders that were surveyed, how many of those specifically were in healthcare?
Say that again, Eric, you broke up for a second.
Out of the 1,000 corporate leaders that were surveyed, how many of those specifically were in healthcare?
That's a good, specific question. And people are welcome to email me after the call, and I'd be happy to dig into the data and look that up.
Okay. The other question was around, when you think about real world examples, and I know, Ben, you gave a few in your slides, but if you think about real world examples of embedded finance, what are the most powerful examples that you have? Itai, maybe you go first, and then Ben would love to hear your perspective on it as well.
So I think top of mind is maybe the established players that have been running it for years. Shopify with Shopify Capital is a very powerful offering that complements what Shopify has built in a vertical way. Uber and Lyft both launched driver wallets and banking experiences. I'll invite you to check the app stores to see which one of them gets glowing reviews and which one seems to be at an okay place. But they're both pretty successful at what they do. And I think it's all about thinking about the audience, right? So all these companies, I think what really makes you successful is thinking about the needs of the customers you serve and about loyalty and assets that you have that you can leverage into being successful. One genius move that Uber did is I'm going to push funds to your account for free instantly for today's rides if you use the Uber wallet. So you can see how they sort of navigated this and created the right loyalty incentives. These are just three names top of mind. AngelList launched banking recently. They've done this in a very thoughtful way that includes incorporation, banking, and the legal side. So these are the ones that come to mind.
Ben, anything to add there?
Yeah, I think Itai stole all the fun examples. So I definitely agree with everything he said there. And just to accent, I think Uber is a great example. This is a somewhat old statistic, but there was a couple of years in the late 2010s, 2016, 2018, where it was reported that Uber was actually the largest originator of small business bank accounts in the US. They weren't offering those bank accounts themselves, but drivers had to have bank accounts in order to drive for Uber. And so they were referring people to bank partners and signing them up. So I think that's one great example of how, for several years, these software and platforms companies have definitely been impactful. But let me provide a couple additional examples that are more established. So these are going to seem a little bit more old school, but I think that they are super impactful. So the first is airlines have offered co-branded credit cards that are deeply integral to their customer experience and their loyalty programs for many years, 20 plus years, right? And it's a truth that sometimes those airlines are earning more money off of the credit card programs than they are from flying planes around. In fact, that was certainly true back in the post 9/11 days, but as recently as 2 months ago, we talked to an airline CFO that said, we are basically flying credit card acquisition channels. Our flight attendants are up there signing people up for credit cards because they earn so much money from those. So that's, one example that we, probably all have an airline card in our pocket or have heard that pitch while flying through the air of, hey, sign up for this card, get a free flight. The last one I'd say that I think is, really impactful is probably auto finance companies. So all the way back to, the 20s or 30s, when GM and other manufacturers started getting into auto finance, these captive auto manufacturers have enabled automobiles to become kind of universal consumer goods in the US. And everyone who has bought or owned a car new has probably gotten some kind of 0% or discounted lending offer from one of these captive auto finance companies. And that's an example of embedded finance. Even if it isn't necessarily a new example, that is a great example of bringing a financial service and placing it close to the life moment that it's meant to enable.
Those are some
Another.
Oh, go ahead, Itai.
Sorry, Eric. I was going to add that I think our favorite examples are going to be also lenders adding banking. Lenders are in a great position to incentivize you to take lending from them. The lending business feeds the deposit business because if they deploy funds into an account that they host, they can monetize the interchange and they can see more data about you. So it kind of fuels the lending side, but the opposite is also true. So I think seeing more and more lenders getting into that business is going to be a real wave that we're seeing in the next couple of years.
So those are a lot of good examples. And somebody else put a very good question in here, which is, what's preventing everyone from doing it right now? What are the key blockers? So if there's so many amazing use cases, why isn't literally everybody doing it? Probably a question for either of you, whoever wants to take it first.
Yeah, I think I'll go first. I think there's a couple reasons. First is for a long time it was hard. It continues to be hard, maybe just not as hard. But historically, it was very hard to get into embedded finance, establish partner, even if you were doing it through a partnership path, right? A partnership path would probably cost a couple $1 million to find a partner to integrate with their systems and the legacy stacks that financial services companies often operate on, and then make those products a success. And sometimes the business case was even there to fully get into financial services as a chartered bank. And we saw historically a lot of retailers or these auto manufacturers would actually own and run banks, often based in Utah, to run these operations. And the market shifted away from that because it actually has proven very complicated and very expensive to do that, and has shifted more towards a partnership model in both lending and cards. And so I think that's part of it, is it just used to be hard, and the perception of how difficult it is changing as the market changes and new solutions are coming to market to make it easier. I think the other part of it is you have to think about what the business goal is, right? And it's important to start with both your customer and what pain points or jobs to be done am I trying to solve, and what's my business objective for doing this? Am I trying to increase revenues, increase customer stickiness, something like that, and then go into how can embedded finance solve that? It's important not to start with the solution and then seek out a problem. So a lot of times companies probably are just focused on other areas, or investing in other things to solve some of those things. It isn't necessarily that we're searching to put embedded finance at the top of the list, but sometimes it is a great solution for the challenges that companies and their customers have.
Ty, anything you want to add there?
Yeah, so two things. Thanks, Ben, for doing my job on the infrastructure side. I'll add something that we see. I think the ratio of supply to demand is still overwhelmingly low. So even with modern players that accelerate go-to-market, I think the pipeline sizes of companies like us and our peers, plus the banks that are supporting this ecosystem, are just massive right now. If you take the demand and multiply it by 10, the pace of go-to-market is still going to be relatively constrained, because companies like us have the capacity to launch hundreds of companies per year. But you could see a much faster increase in the demand. And I think there are 30, 40 banks that most people know in fintech, which act as the go-to banks for embedded finance. These banks have a business development or sales team of 3 people at most. What happens when you overwhelm them with calls and demand, and what's going to happen if you multiply that by 10? This is going to be, we're still at a place where I think supply is constrained, but it's opening up. That's the good news. I think the other point that I wanted to make was competition. In every space, you see one company making a move and then 15 competitors rushing to match them, right? Every space that has a new killer feature that somebody launches that seems to be increasing loyalty, monetization, distribution, all of your competitors are going to take notice. And so I don't know if any PFM in the country, personal financial management tool for consumers, that doesn't add financial features or bank accounts right now. I think a lot of companies that do account payables or invoicing tools are also going to match to do the same, because in every one of these verticals, you have a fast mover, and then you have everyone else that rushes to match what they have. So I think competitive dynamics will play the 90% effect, and the first movers are kind of giving you the sign that there's a 10% there.
Yeah, Itai, I think your point on supply is a great one. Just to give everyone an example of that, if you want to launch a co-branded credit card, you can go to the Visa, MasterCard websites. They list banks that are in that business of offering co-branded cards. There's probably a dozen banks on those lists, maybe 20. And if you broaden it beyond co-branded cards and you say, what's the entire universe of banks that are interested in BEN sponsorships or white label financial products or partnering to enable embedded finance, you might get to a list of 100 banks, 150. And Itai, I know you have that list on your desktop. That's out of 11,600 financial institutions in the US, right? So it's still very niche. And I think that also goes to the opportunity for financial institutions to play a partnership role here. There is still a lot of limited supply to make these kind of experiences happen.
Ben, this might be best suited for you, but there was a number of questions that touched on kind of the regulatory environment and what regulators can do to kind of either make it easier or harder to develop and implement embedded finance solutions. Any thoughts around that?
Yeah, I think it's something that is definitely a dynamic space. Regulators are just starting to take a look at these partnerships and express some opinions about them. I think we have seen partnerships that include both the partner and bank brand transparently as something that's pretty mature, right? We've had co-branded credit cards and other kinds of partnerships like that for 20, 30 plus years. The partnerships where the bank is totally white labeled in the background and they may just be originating a loan and selling it off the next day to a partner and basically stepping out of the way. That's where we see regulators and the courts investigating those kind of partnerships a little bit. That's where we definitely see some dynamism. So I don't know that there's anything regulators can necessarily do for non-financial companies to make it easier. I do think they're going through a process with the financial institutions that they oversee to express more clear guidance on these sort of partnerships. And I think the complexity of regulation, also goes back to why partnership is often the right path in this space. Financial institutions have a lot of experience with the regulations. They know the regulators that are overseeing their institutions. They're in communication with them about their business plans, and partners are able to benefit from all of that when they pick a financial partner that has some experience in the space.
I think a good analogy that I would like to offer for why the new ecosystem of infrastructure is safer than the old one is what Plaid did to data exchange. What kind of environment do we want to live in from a regulatory point of view? One where 11,000 financial institutions sign bespoke deals with 5,000 companies or 6,000 companies? Or do we want to see a company that takes data, privacy, security seriously and acts as a company that helps facilitate the exchange from a regulatory point of view, legal point of view, and consumer protection point of view? So this argument is easily applicable to the Plaid business because we can see how established the company is and its approach. But I think the same argument will be easily applicable to how you see embedded finance being applied, because there are so many things you have to watch behind the scenes from an oversight point of view that these companies that help concentrate the demand and the supply, if they do their job in the right way, will help create a much safer and more sustainable kind of partnership model.
That's actually a great transition. I mean, at Plaid, we've always been very focused on security, transparency, and control, and I think that's earned us a lot of trust with the developer community and with consumers and institutions alike. If you think about a smaller startup kind of building that trust with users, how do you recommend, or do you have any advice, Itai, for how you see startups best doing that?
So I think trust has to be built by giving value, right? Shopify never, I'm sure they had a bunch of trust initiatives, but they earned trust first and foremost by being a reliable and trustworthy place to do business as a shop. I think that in embedded finance, trust is gained from being a good counterpart to your customers. And embedded finance is what pops up to help you leverage the assets you've built in the form of trust distribution data software into more revenues and better experiences. So I think how to build trust is really, how do you do business day to day, right? United hasn't built an explicit financial based trust base with its clients, but it has flown them to places and earned the right to give them more products.
And then the other question that I thought was interesting is, if you think about it, for a brand or a developer, any company that's kind of starting to build embedded financial solutions, how do you recommend they mitigate the risk that something might happen with their partner, right? Where suddenly they will no longer be able to offer or scale that solution. Ben, maybe kind of we'll go to you first, and then I'm sure Itai has something to add on that question as well.
Yeah, I mean, I think it's an important question, and it goes back to what the principles for how to enter this space the right way. In the paper that we wrote, there were something like 7 principles for both banks and non-financial companies on, keys to success for embedded finance partnerships. And one of them was picking your partners carefully, because these are really long-term partnerships. And if you look at some of those more established examples that I mentioned earlier, some of the co-brand credit card relationships out there are 20 plus years old between one brand and one bank. For 20 years, they've partnered together. And so, picking somebody that, A, is a cultural fit and you think is going to be evolving, in the right direction and at the right pace, that's certainly important. But also making sure that you have good vendor risk management or, partner diligence processes and approaches, that you pick partners that appreciate the risk and complexity that's involved here, that appreciate that financial services are not necessarily a move fast and break things sector, right? If you are either lending people money and it's impacting and being recorded on their credit reports, or you're asking them to give you their money for safekeeping, there is a high degree of responsibility that exists there, which, if you do a good job, translates into trust earned. And so I think it's just about picking partners carefully and looking through the multiple lenses of, is this the right cultural fit? Do they have the right capabilities? Do they appreciate and understand the compliance and risk complexities of this space? Do I think they've built their solutions and platforms in a stable and scalable way so that we can grow together? And just getting comfortable with those companies you pick up front. I think that's probably the key part of it, because it's just so hard to try to mitigate all of the business continuity risk in these partnerships when you're coming from such different and complementary places. I wouldn't necessarily recommend that a retailer or a tech company that's looking to partner up to offer embedded finance build out a lot of those capabilities on day one just for the sake of continuity. I think it's much more around picking a partner that you trust.
I think the bank selection is a very important step, because there is a path of least resistance that pops up when a new bank that maybe doesn't have as much oversight or willingness to oversee activities gets into the ecosystem, right? So going back to my point about supply and demand, if we start the 101st bank that does fintech partnerships in the country, I'm sure we're going to get a lot of companies approaching us. But if even one of the clients we accepted has any sort of regulatory issue, it can affect the bank systematically, regardless of structures, right? It's something that regulators are managing. They have one point of failure from a regulatory point of view. So just choosing bank relationships carefully and making sure they're running on the right rails is something that has to be top of mind for most companies. And making sure that there is a regulatory line of sight to the bank too, right? One of the things that we chose to do differently at Unit is we insist to sign a tri-party agreement alongside the B2B SaaS agreement that we have with the bank, to make sure that from any sort of line of sight point of view, the bank and the client know each other and there's direct relationship between them.
And then speaking of banks, there was a number of questions in here as well about the role of banks and other financial institutions when it comes to extending these types of offerings. So kind of the first question really is, how can financial institutions be best prepared to help be the banking engine for fintechs? And kind of related to that, to some extent, a lot of banks are already doing that, but how can they really make it a core capability? Itai, maybe this one, given your experience, you go first on this one.
Mm-hmm. So I think the road is partnering and identifying a stack that you can take to market consistently. If you're a bank that wants to participate in the space, but you haven't identified the tool set that you're going to to put in place to enforce what you care about from an AML point of view, from a KYC point of view, complaint management, statement creation, card issuance, reconciliation. If you don't have this toolbox, you're going to struggle to scale that practice and even to gain oversight over the initial relationships you have. So I think it needs to be a deliberate decision, not an afterthought. It needs to be board level decision, and it can't come at the expense of being a bank, because for most banks, it is and it should be an additional business that diversifies how they do business usually. So it needs to be deliberate, it needs to have the right toolbox, and banks need to see themselves as operating in the space for years, because the main banks we know today in the space have built their compliance practices, their sales practices, their oversight over 5 to 10 years, and it's not going to be an overnight success.
Yeah, I agree with what you said there, Itai, around the need for banks to view this as an intentional business, view this as something that they really have to want to be in and dedicate resources to it. We actually see that with a lot of the banks that are in this space. They have strategic partnership teams that are totally focused on originating these kind of partnerships. They have unique compliance teams that take a look at those partners, program managers that work together with those partners to make sure that they're operating things in the right way. And then I think for banks also just appreciating the unique capabilities that they do bring to the table, right? I mean, like the question there on the page, what's a bank's role? Banks have a ton of role to play here. And we keep saying bank, but as we think broadly about embedded finance, it's all kinds of financial institutions, banks, insurance companies, investment firms and brokerages, et cetera. But one part of it is that understanding of the regulated environment in which they operate. Another part of it is that deep understanding of the products that are being offered. And there's a lot of good complementary almost tension in that. Banks bring deep understanding of the way these things are working. Embedded finance partners, non-financial partners sometimes bring that first principles thinking on how can we approach this differently to solve the customer need. And then also, I think banks are providers of capital. They're adjudicators of risk, and they have a lot of experience in doing those kind of things. And it's only beneficial for partners to work together to leverage those capabilities that the banks have, and also look for the non-financial companies at how they can help the banks in those regards. For example, making the data that they may have on customers and on activity on their platform and so on available to their financial institution partners, so that they can be more sophisticated or more targeted, more personalized in how they're serving customers, who they're approving for credit, how they're pricing insurance policies, et cetera. And that's some of the most magical types of embedded finance that we're seeing out there, is not where it's just a plain vanilla product on the shelf, but instead it's something that's deeply integrated. And then also you're using data and other resources that you didn't have access to before to make it work better, to make it more accessible, to make it cheaper, to make it more personalized.
Thank you, both of you. We're coming up on time, so just want to thank everybody for joining this afternoon, and a big thank you to both Ben and Itai for all their thoughts, sharing all their insights, and kind of answering all the questions. Really, really wonderful. I appreciate the time, and I hope all of you have a wonderful rest of your week.
Thanks, Eric.
Thanks, everyone. Thanks, Eric.